some things: the sales price and the date of sale. We need to know what kind of property it was, business or personal in use. We need to know when we bought it. We need to know how much we paid for it, or our basis in it. And our basis is determined by how we got it. We purchased it, we received it as a gift, we received it as an inheritance. We've been down the gift and inheritance paths to determine basis, to determine amount of gift tax that we could add, depending on if the gift was made prior to 77 or after 76. We could have added all of the gift tax, we could have added some of the gift tax, we could have added none of the gift tax if it had depreciated in value. We determine the gain or loss comparing the sales price with our basis. And near the end of the hour last class, we were talking about holding period, talking about date basis, especially for gift property. When we step into the shoes of the donor, what rights and privileges do we get? Could somebody on the front row loan me your handout just a second? Why did we run so short of handouts last time? Oh, I guess Bosa wasn't here that day to get that handout. This one. Yes, we're doing the back sheet of this, item 2. Assume that on February 14th of the current year, a donee sold under the alternate conditions detailed below an investment property she received as a gift January the 8th. Assume further the donor had purchased the property on October 26, 74. State the amount and class, short-term or long-term, of capital gain or loss realized. My recollection is that we did 1 and that we might have been working on 3. We have not done 3.
I think you were about to start.
I was about to start 3, and I think that's where I am right this minute. It says 3. Yes, everybody? So, Bosa does have it. Can we share this? Some generous person paid $11,000 and $500 of gift tax for property they gave to us when it was worth $10,000. We later sold it for $9,000. And what we've discovered in this is that for gifts of depreciated property, it's possible to have 2 bases, a basis for gain and a basis for loss. And that's determined by the sales price. The problem says that we sold this for $9,000. And we've got to decide whether it is the donor's basis, 10, or the value of the property. Are we doing 3? 15, which is the basis of the gift. This is appreciated property. Am I reading this correctly? Yes or no? Isn't that a sneaky little way I did that? Have you made up your mind? Mikey? The basis of the property is, didn't hear you. Mikey thinks 10. Matthew?
I'm not sure.
Dwayne?
10,000.
10,000. Because?
Well, it's just based on what the chart says here. It's a lot.
What does the chart say? You're referring to the decision tree, I think? Okay.
It's a loss, so the fair market value.
It's a loss. Okay, so our 2 possible bases are 10 and 15. Am I right or wrong?
10 and 11.
10 and 11. Where to get the 15?
You look at the.
I was looking at the wrong one. Yeah. We're doing item 3?
Part 2.
Thank you. I was looking at part 2. I don't know where the 15 came from because I don't see a 15 on here anywhere. So the donor paid 10 and the value on the date of the gift, sorry, the donor paid 11 and the value on the date of the gift was 10. Did I ask about gift tax? How much gift tax can we add, Jake?
0.
Why?
Because of depreciated.
It was depreciated property. It's declining in value. We only get to add all or some of the gift tax when the value of the property went up in the donor's hands. When it goes down in the donor's hands, gift tax is not an issue. So we've got a possible basis of 11 donor's basis, or 10 fair market value on the date of the gift. And Mikey picked 10, Dwayne picked 10. Tell me one more time why?
Based on.
But can you
But,
say that without referring to the decision tree?
Due to the fact that the fair market value is actually less, so it's a loss.
It's gone down even more than that.
So-
Yes,
so
the
it's-
sales price is less than either of those numbers.
Exactly.
So are we going to give this taxpayer the right to deduct the loss that occurred in the donor's hands? That's the real question. The law is that we're going to limit the loss to the amount that occurred in the taxpayer's hands. Because the chart said so. No, this is why the chart says what it does. Are you with me, Dwayne?
Right.
What's the basis in this property? Everybody said? It's $10,000. And therefore, the loss is $1,000, and I'm not sure that's the main lesson. I'm not sure that's the reason we're doing this set of illustrations. I think this problem is more about establishing the holding period, the date basis, than it is the dollar basis. So help me classify this loss as short-term or long-term. You need to make up your mind right this minute. And you need to back it up. Once you've made up your mind, you need to say short-term holding period this to this, or long-term holding period this to this. Logan?
Say short.
Would it help, Logan, if I labeled the parts?
Sure.
We acquired it in '74, or the donor did. The donor gave it to us at point B in January of the current year, and we sold it C February 14th in the current year. So is it A, C, therefore long-term, or B, C, therefore short-term?
I'm gonna say AC long term.
Toby?
My initial thought was BC. Now maybe it's AC.
Logan had that much influence on you?
No. I
Jeff?
AC.
Therefore long-term?
Yes.
Shane?
BC.
I think I've got a tie score. Not that I anybody's keeping.
I'm worth 3 men, so you're right.
Yeah.
It's 3-1.
Yeah.
Yeah.
It's-
I thought it was 2-2.
No.
Matthew?
AC, long term.
Drew?
BC.
Ma- well, based on the past 2 votes, there's a tie score.
Nah.
Would it help if we put dollar amounts with each of these? So what did the donor pay for it at point A? 11,000. And when he gave it to us, it was worth 10,000. And we sold it when it was 9,000. Now here's the crux of the issue. A moment ago, we determined the gain or loss and used this sales price and which of those 2 possible bases as the basis, both of them. Say a number, 10,000. If we use 10,000 and you seem to be in agreement on that one, you seem to be in one accord on that one, yes or no?
Yes.
You can't switch them around. You can't pick and choose. If you use that dollar amount, you have to use that date as well. Is this loss short-term or long-term? Say something.
Short term.
The holding period is, Drew, speak up.
From B to C?
Everybody say
BC.
BC. It's short term. Are you with me or not?
Yeah.
That may have been the reason that we did this exercise. Okay, that may be the point right there. That too bad we didn't do 1 and 3 in the same time period. Because in 1, it seemed obvious it was going to be long term, and it seemed like it was going to be long term all the time. And this is the point that I'm trying to make. If you pick the Dome North basis, then it is long term in this case. But if you have to choose the more recent basis, the date of the gift, then the holding period starts then. If you've got a question about 3, you ought to ask me right this minute. So, we're going to switch gears a bit. The question is, what happens next? So we've got an idea about basis, we've got an idea about determining gain and loss, we've got an idea about holding period and classifying. Hand those to Toby, and hand those to the third row, and hand those to Toby. Thank you. Give me one when it comes to you, Jeff. Please. Thanks. So, in real life, the question is, what would we do next? So, let's say that this is somebody that buys and sells stocks, has lots of transactions daily, or buys and sells other kinds of property, and has lots of things to classify, lots of exchanges, lots of sales of assets. Then literally, we would want to look at the consequences, the evidence that we're given, and make 2 piles. We want to put all the short-term transactions in one pile. We want to put all the long-term transactions in the other pile. Can you tell the difference in them? In the things that are in this pile? Are they all alike? Some are blue and some are red, but what is the significance of that? The blue ones are maybe
Long term.
gains. This is the short-term pile.
Why'd you do that?
And the long-term, the red ones are losses
Long-term.
maybe. And what about this? The blue ones are their gains. And the red ones are losses. So we would probably do this on an Excel spreadsheet these days and let the Excel spreadsheet do the math. And maybe even put dates in and let the Excel spreadsheet do the classifications. But this is a holdover from literally having pieces of paper to do it. The electronic version of this is maybe not the way I'm describing it, but maybe you could relate to having a piece of paper that would be evidence and piling them into 2 piles. And it's holding period that establishes this short-term and long-term distinction. We would want to sum each of those piles to get one net result of all those things. We want to know the total of all the short terms, net short-term capital gain or loss. We want to sum all the long-term items and get net long-term capital gain or loss. And then we want to decide about what to do with those. If those, one step ahead, let's catch up. Net short-term capital gain or loss. Net long-term capital gain or loss. Are you with me, yes or no? And then we would combine those 2 depending upon the signs of each of these. If their signs are alike, you don't net them. When their signs are alike, they keep their individual characteristics, their individual names, and you don't combine them. When their signs are different, one more time, when their signs are alike, you don't net them. When their signs are different, then you net them and find one net result. And whichever one of those was larger gets to name that one net result. If short term's more than long term, you say net short-term capital gain or loss. If their signs are different, you net them into one number. Now, I just want to go on one quick trip back. When I gave you that historical perspective and described to you the lean years where we had nothing but the alternate tax rate, the maximum 28%, and said on a couple of occasions, Congress left all the laws in place. We still had to do all the classifications, go through all the motions for very little or no payoff. There was no long-term capital gain benefit, or practically none. It was these kinds of things that we still had to do. All the capital gain rules were in place for those 11 or 12 or 15 years, whatever it was. We kept going through the motions. We had to classify them. We had to report them. But if your marginal tax rate was less than 28%, you got no capital gain benefit. We kept thinking that it was all going to come around again, that it would be easy to put the capital gain benefit back in because these rules were all still in place. And it was. And Congress did. And there is a capital gain benefit today, and these are the ways we classify it. How about opening your book to questions at the end of chapter 5? And look with me at 545. It's on page, it's 548 on page 545. And we're going to do just that. 548 on 545 says, consider the 4 independent situations below for an unmarried individual and analyze the effects of the capital gains and losses on the individual's AGI. For each year, determine AGI after considering the capital gains and losses. Would you look in your book, maybe even on your handout, and on the screen, and compare those 3 things and audit me? Do I have the facts right? Yes or no? Glance, glance, glance.
No.
Logan, is that you protesting?
Yeah, your long-term capital loss is 500. No, I really don't know.
Okay, Logan, it's okay. I need somebody to look at it with good eyes. And if I were you, I wouldn't write it down at all. I'd use this piece of paper. If you've already done this because it was assigned, fine, look at it, but I don't think you're going to do it in my approach, and you might want to follow along on this approach. There are lots of ways we could do this. This one is just for understanding's sake. What's the matter, Mikey? You all right? So, let's do what I just described in the previous part of the handout. If there's signs, first of all, we make 2 piles. So we need to combine the short-term items here. There's a 6 gain and a 2 loss. When we net those 2 together, we're going to get 4 gain. Yes or no? Yes or no?
Yes.
And the 2 long terms are 3,500 gain, 2,500 loss. That nets out to 1,000 gain. I'm doing this first one too much. I'm expecting you to help me on the next 3. Okay? Now, what did we learn a second ago in the illustration? When their signs are alike, you don't net them. They keep their individual characteristics. And sure enough, we've got signs alike. They're both gains. So the problem said, state the impact on AGI. Well, we've got AGI 40,000 that we're going to slide over and consider part of the total that we're trying to achieve. The 4 gain becomes part of AGI. The 1 loss becomes part of AGI. We simply sum that amount, and AGI this time comes out to be $45,000. If you're with me right this minute, say yes.
Yes.
Now, it'd be nice if you didn't get so consumed in taking notes that you did a little thinking along the way too. One thing left is remaining to be done, and that is to mark a portion of this that would be subject to special tax treatment. What is the amount that gets special tax treatment? And in previous classes, I told you I was going to let that asterisk represent special tax treatment depending upon the year that we were talking about. In early days of capital gains and losses, we would throw out 50% of that and tax 50%. Then it became throw out 60% of that and tax 40%. Then it became tax that at a maximum rate of 28%. Special treatment today means use the capital gain rate appropriate for the marginal rate of tax in which that taxpayer is that year. The capital gain rate is less than the marginal rate of tax, the regular tax, at every level. What does special treatment mean? Well, if we know that for those periods of time, then we can be content to say this is the portion that would be taxed differently. Short-term gains are fully taxed. Long-term gains get special tax treatment. If you've got a question about situation one, we ought to talk. Shane?
You said that the long-term capital gains tax is less than the marginal tax rate at every level?
Under current law, that is true.
Isn't it 15%?
It is not true. It is 15% for certain tax brackets. And it is commonly 15%. If you just want to know one tax rate, it's 15%. We'll either get to that this class period or next time we'll go into detail.
Okay.
Matthew?
What if your only income is capital gains? And then you don't really have like a, I guess your marginal tax rate is for 0 to...
It would still... What
I
a
mean,
good question. I understand the question. And
It would just be really low, so you could be making massive amounts in capital gains and have...
problem?
no, that's not McBurney's problem. Let's talk about that in a minute when we
Okay.
get to it, okay? That, it deserves an answer. I don't know the answer right this second, but I think I can come up with one, okay? Let's do this. I did that talk already without that stimulus on the screen. What did that asterisk mean a long time ago? You already heard me say it with words. What did it mean in that period of time? You already heard me say it. What does it mean now? It means lower tax rates at every level. Glance at situation 2 in the book, compare it to your handout, compare it to what you see on the screen, and answer my questions. You've seen one demo. That's an interesting way to do that.
That's it.
Toby held it up and closed one eye. And apparently he could see them side by side and audited me. It was a good thing. Help me with the steps. What's the first thing we need to do?
net short term.
We put them in 2 piles, and then we net all the short terms. Matthew, help me with the math. Net the 2 short terms and get
3,000 loss.
3,000 loss. Next step is new volunteer.
Long
Dwayne?
Long term.
Net all the long terms. What'd you get, Dwayne?
11,000.
11,000 gain or loss.
Okay.
That's an $11,000 gain. Don't let them do all your thinking for you. Don't just take notes. Practice right this minute, okay? And the next thing we need to do is, Toby,
Net the 2 piles
because
because they're different signs.
if their signs are the same, we don't net them. If their signs are different, we do net them. We're going to subtract the $3,000 loss from the $11,000 gain and get, Toby,
8,000.
didn't hear you,
8,000.
8,000 gain or loss.
8.
Short term or long term?
Good question.
I thought so.
Long term.
Long term. Do you see the impact of Toby's decision right this minute, and do you agree with his answer?
Yes.
We need to know that. It keeps its characteristic, and when we net those that have different signs, the larger one gets to name the result. It's long term. Ultimately, we'd like to know the impact on AGI. We're going to scoot the $50,000 over, include it in AGI. This $8,000 becomes part of AGI. AGI is $58,000, but the significant part of that is it is the $8,000 that deserves special tax treatment because it was long term. Situation 3, ooh. So that asterisk was beside that $8,000 because that was technically named net capital gain. And I'm wondering if anybody in the room can literally define net capital gain. Have you found it in the chapter? Do you know its significance? Can you say it without reading it to me out of the book? What is net capital gain? Then can you find it in the book and read it to me out of the book?
It's not just capital gains.
You're not even looking.
I know, but
I mean, it seems.
it seems
Like-
obvious.
Yeah, it seems like it would just be.
If it is so obvious, then say it. It is
Capital-
not so obvious. It has a very specific technical definition. And we just experienced it. Logan, you're usually my guy. The book guy. Jake, have you found it?
I think so.
Let's hear it.
The excess of net long-term capital gain over net short-term capital loss.
On page,
17,
now direct the class.
top of the page.
517 at the top of the page. Read it again, Jake.
The excess of net long-term capital gain over net short-term capital loss.
Jake,
Yeah.
read that again one more time.
The excess of net long-term capital gain over net short-term capital loss.
It's called.
Net capital gain.
Isn't that exactly what we did right here?
Yes.
The excess of long-term gains over short-term losses. It's the first time we've done this. Because in the previous situation, we had gain and didn't combine them. Remember that? We had a short-term gain, we didn't have a short-term loss. So the excess of long-term gains in situation 1 over short-term losses, 0, was net capital gain, the amount that we put the asterisk beside. And net capital gain in this case was a gain position for long-term, a loss position for short-term. Those get netted. And the amount that survives gets special tax treatment. That long-term gain was the amount that would be taxed at reduced rates. The excess of long-term gains over short-term losses is literally net capital gain. It's a tax term. It's the amount that deserves special tax treatment. Would you skip with me to situation 4, just in the interest of time, and tell me, oops, never mind. Okay, let's do 3 after all. I thought we were going someplace else. Are these the facts, Toby?
Yes.
Tell me the benefit of holding it up like that.
Just quicker. Like, I don't have to go up and down. I can just go side by side.
You like that, Matthew?
No, you have to refocus your eyes each time.
You can.
Me? You like that or not?
I don't have good eyesight to begin with.
So,
How does that
let's
help?
do situation 3. Step 1 is, come on everybody participate. New volunteer? Drew?
You put them into piles.
Is that the same answer you gave me last time? Next time give me a different answer, okay? I appreciate your participating. Put them in 2 piles. We got all the short terms together, all the long term piles. Now what, Brady?
Substitute file?
Mm,
Short-term gain from short-term loss?
we got to net the 2 piles. We got to get to one conclusion in the 2 piles. We want to net a net result. What's the short term result, Brady?
1,000 gain.
1,000 gain. What's the long term result, Mikey? 2,000 loss. I'm afraid to punch the button. Now what? Jeff?
Net those two together,
Because,
they're different signs.
what'd you get, Jeff?
Negative 1,000,
What's the name of that?
net capital loss.
Well, it's not net capital gain, right?
Yeah, kind of what I figured.
The big deal I made about net capital gain, it has to be a gain. This is a loss. What do you know about this difference, this $1,000, Jeff? What is the proper tax treatment of the $1,000, deductible or not?
Deductible, but at a special rate.
No, it's deductible. It might be deductible, it might not be deductible. Depends on what it is, depends on the nature of the property. If this is stock, is it deductible or not, Jeff?
No.
Logan?
If it was realized,
If this is stock that I sold and had a $1,000 loss,
yes,
deductible.
yes.
If this is my wife's diamond ring,
If it was completely personal, which sounds like it was, then no.
I thought we went through that already. Y'all remember that?
Yes.
Mhm.
Some losses are deductible, some losses aren't deductible, and that's what I was trying to prick your memory about. We're going to assume or conclude, maybe it says so.
Did it
It
say
didn't. But we'll assume it's investment property and that this loss will be deducted. And we've got $60,000 of AGI otherwise. This $1,000 loss would cause AGI to be $59,000. Special treatment for capital gains. Capital losses are fully deductible.
So they call it net capital loss, that's not really
We can call it that until we find out better. Let's consider another problem. Situation 4 has these facts on the handout in the book and on the screen. Toby,
Yep.
what are you going to do, Toby? Step 1 is,
I'll make 2 files.
and we did, sort of, we've got all the short terms together and all the long terms. Then what, Toby?
So find the difference between the loss and gains for the short term
It
is
is
a loss of 9,000.
$9,000 loss. What's the next step, Bosa?
Do the same thing for long term,
And get?
5,000 gain.
Good. Now what, mean?
You net the two,
Because
because
they have different signs, so we're going to net the two, and they net out to $4,000. Everybody's with me right this minute, I'm guessing, yes or no?
Yes.
Tell me, some new volunteer, the proper tax treatment of this $4,000.
Not deductible.
Jake?
Not deductible.
None?
No.
What about the $1,000 in situation 3?
That is because it's long term.
Ah, so you're saying because this was short term, none of it would be deductible? Interesting. Anybody agree or disagree? Shane?
I think I disagree.
I think you need to look back at another handout. I think what you're going to see is that short-term losses have historically been fully deductible. Long-term losses were deductible, then they were only half deductible. Now they're fully deductible again. There is one other string attached that I'm not willing to say to you right this minute. I'm going to let somebody else say. But this would be deductible. Okay. Mikey?
Deductible, 3,000.
Dwayne?
Up to 3,000.
I read your body language. The annual maximum on capital losses is $3,000. We can deduct $3,000 of this year. What happens to the rest? Carried over how long?
Till you
5 years?
till you die,
Till you die.
not forever.
Good point. Did that? It would be carried over as short term, by the way. And we're going to do that again in a minute in another problem. We already did how long? That's the other side of the shit. Indefinitely. Jeff?
So what's the difference between treatment of short-term losses and long-term losses?
Nothing.
That's kind of, okay, that's good.
Shane,
I'm sure we touched on this before, but what is the reason that they limit the loss? Do you know?
because it saves you tax dollars? It reduces your tax?
No, I'm saying why are they limited to 3,000 that you can deduct rather than?
Are you asking me why 3,000?
Mm-hmm.
I don't know.
I mean, why limit it all?
Because it saves you tax.
Would it save you more if they didn't?
No. Yeah, it would save you more. That's the whole point. They need to raise revenue. So they're limiting your loss. Logan?
So you don't get 3,000 for short-term losses and 3,000 for long-term, you just get 3,000 for losses.
That is correct. Capital losses. Jeff?
So if short-term and long-term are both losses, why can't you just net those if they're the same treatment? Long-term, I mean, gains, it makes sense because they have separate
You
treatment.
can't. Stay with me. I'll show you.
Okay.
I hope. Okay, let's play what if on this one. This is the same problem, except I'm changing the long-term loss to 16,000. So would you watch the screen with me as I make these changes? Look up. So the long-term loss is over there at 4,000. Do you see it? That was the way we worked the problem. So let's change that 4,000 to 16,000 and work through it with me. How about helping me with the math? This now netted makes this, didn't hear you? $7,000 loss. That $7,000 loss now combined with the 9,000, what happens?
You don't.
Net them or not? Jeff,
Uh,
and that's what you just asked me?
It is.
Just like we rehearsed, right? So we don't net them. They keep their individual characteristics. Somebody else asked, Logan, how much can you deduct? 3,000 short-term and 3,000 long-term? Shane?
Never mind.
Logan?
3,000.
3,000 period. 3,000 total. Then the question comes, where do we get that 3,000? Where does the $3,000 deduction come from this year? If you know, volunteer. If you don't, I'm about to tell you. I'd rather you tell me. Anybody know?
I mean, would we choose to take it for short term or long
That's
term?
correct. Where does it come from? Logan?
I would take it from short-term.
You're just making up law right now. I would say, oh, let me think.
I mean, if I got to choose, I'd take it from short-term.
It comes from short-term first. That's the rule. And that's why we keep them classified, Jeff. That was the answer to your question, too. That I put you off on just a second ago.
That's what my tax sense told me, but I don't know why.
I don't either.
I was thinking the same thing. That's crazy.
Yeah.
But if there's no difference between the treatment, then why does it matter where it comes from?
Because the law says to do it this way. It's called compliance. This is what filing tax returns is. We comply with the law. We do it like the law says. Now, if you would like to interview the congressional aide that made this up, that got the senator to put it on the...
It just doesn't make sense.
I understand what Jeff is asking. It's like,
You treat the same thing.
it's all just dollar amounts.
I
Like,
understand it, but I also know what the rules are. And I'm just here to tell you what the rules are.
So if that's a loss of 1,000 instead of a loss of 9,000,
How many what ifs can we do on the same problem?
quite a lot.
a lot.
So you,
We'll do one of those in a minute.
okay.
Thank you very much for being curious. So, 3,000 gets deducted this year. AGI is still $67,000 like it was a minute ago. Now, what is the amount and nature of the carryover? How much short term? 6. How much long term? 7. And they keep their individual characteristics. They're put in that pile next year. They get netted against the same kind of thing, shorts or longs, next year.
I think that answers Jeff's question, because it matters next year because you don't know how much short-term gain or long-term gain you're going to have next year, and so it matters which pile you take it from this year.
I say you're right.
That answers the
That
question.
would make sense. That's the only
Well, I kind
good job, everybody.
of answered that. You answered that. I'll uncle to that. But there's still that other question that you asked that we don't have an answer for. Why the shorts before the longs? We didn't answer that one.
Right.
Okay. So we determined this 6. You told me that already. We determined that 7 already. We're going to come back to this idea in a minute or two. Let's do something else. I think it's 61. And it says, Betty incurs the following transactions during the current year. Without considering these transactions, her AGI was $40,000. Analyze the transactions and answer the following questions. A, what is her net short-term capital loss or gain? B, what is her net long-term capital loss or gain? C, what's the effect of capital gains and losses on her AGI? D, what's her capital loss carried forward to next year? There are 3 bulleted items on the list. Let's consider each one. March 10th of the current year, she sells a painting for $2,000. Betty's the artist. She completed the painting 5 years ago. Her basis for the painting is $50. Tell me about the painting. Shane?
It's inventory.
Really?
I think so.
So, do you agree with me, class, that she sold it for $2,000, had a basis of $50, and has a $1,950 gain on it? Yes or no?
Yeah.
Yes.
We're trying to decide what this gain is. Shane thinks it is short-term or long-term.
Short-term.
That's not the same answer you gave me a minute ago.
I beg to differ.
I don't. That's not the same thing you said a minute ago.
He's right. Last time he said inventory.
That's
I
right.
said inventory.
And that's different. That is not short-term.
Okay, fair enough.
If it's inventory, what is it?
Not a gain.
No, it is a gain. We've established that.
You said it's not short-term, just a minute ago. It would be short-term.
No.
Inventory?
First of all, I'm going down his line of thinking. If it is inventory,
Huh?
what is it? Inventory always gives rise to
Gross profit.
ordinary income, not capital. We're thinking
Okay.
this 2 days prior to this and 1 day after this is all about capital gains. Does inventory ever give rise to capital gains? No, it is always ordinary income. The classifications, short-term and long-term, are capital gain terminology. Inventory is never capital gain. What if you hold inventory longer than a year and sell it? Do you get capital gain benefit? No, it's inventory. It's always ordinary income property. That is not the same thing as saying it is short-term. Do you understand the distinction?
Yes.
Short-term is capital gain terminology. Now, we're back to the facts. I've got a gain. What kind of gain is it?
Wait, so are you saying that it is not inventory?
I didn't say that.
Okay.
I had to make the point that ordinary income and short-term are not the same thing.
Seems
Okay?
like
That you gave me 2 different answers and you didn't realize it. Toby.
I'd say long term.
Long-term, because she painted it a long time ago.
Yeah.
Matthew.
I'd say ordinary income because she created it.
Is this a capital asset? If you go back to the beginning of this talk that I have recapped twice, of all the things we need to know as we interview the client. So, you sold some property this year. What kind of property was it? That's the crux of the issue. Was it inventory? Is this a capital asset? We need to decide whether or not this is a capital asset. And here's the list you saw. It's not this, it's not this, it's not... Could you just tell me what it is? Remember that day?
Mm-hmm.
Is it on the list?
Yep.
Capital assets include assets held by the taxpayer except certain copyrights, literary, musical, artistic compositions. What do we know about this item?
That's worded poorly.
No, I'm talking about the item she sold.
It is artistic composition.
She painted it.
When I say it's worded poorly, I mean, like, does that mean any artistic composition? Like, what if I just buy like a Monet?
No. No, if
Or
you
it means
painted it. This means
your
you
own
painted it.
composition.
You painted
Okay.
it.
So if you painted it.
I don't think that
how long
it's
do
worded
you
poorly.
hold
I
it?
think that you're not a lawyer. Is really the issue. I think if you were a lawyer,
His
that would.
comment is better than yours. Be quiet.
So no matter how long you hold it, if you painted it, it's not a capital asset.
Yes.
What if your name is Monet?
Could you hear that one more time? It doesn't matter if your name is Monet.
It's mine.
That's what he said.
It's mine.
He said if you painted it, it is not a capital asset. Capital assets are these things. If you painted it, you will never get special tax treatment on it. Well, what if Monet sold his picture, later bought it back?
Then you can sell it again.
Then he could sell it. Then then that's different, I think. Your hand was up?
It just says certain copyrights. What does that mean?
Like I said, it's just not worded
I'm
well.
not going to explain everything on this list. Okay?
That's where they got all.
All right. So, ordinary income, you would have gotten to the right answer for the wrong reason.
Yeah.
Oh, that's all right.
Well,
It's kind of like inventory.
but the thing is, you're right, because it doesn't say that she was a painter for a living, and so I sort of made a jump that I should not have made.
I thought it said that. Sells a painting. Betty is the artist.
The artist, not an artist.
It doesn't say like
It
that.
doesn't matter. She painted this picture.
No.
That's the only one we're talking about.
I'm saying that she doesn't. I don't
He's saying
think
it
She doesn't have many.
Like a business. He's saying it could be inventory if this is her business
What?
that she regularly
But it
does.
doesn't
She
say that.
painted this painting.
Right.
That's the reason we reached this conclusion.
Right.
Could you make I know this is way off course, but could you make a case if you sold the painting to a friend for really cheap and then bought it back the same amount and then held it for a year and then sold it for a lot of money, it wouldn't be a collectible gain?
The answer is you can make a case for anything.
I think that.
You need a lawyer.
Or an MBA in tax. On June 18th, she received $28,500 from the sale of stock purchased by her uncle in 2000 for $10,000, which she inherited from her uncle February 20th of 11 as the result of his death. The stock's fair market value on that date was $30,000. Y'all ready for this? Help me determine her gain or loss. Her basis would be, lots of good choices there. Name one and justify it. Her basis would be, Mikey, 30,000 because is correct. What do we get when we inherit property? What is our basis? Fair market value on the date of death is the right answer, Mikey. Thank you very much. That
Or
number in
6
this
months.
problem is 30,000. Matthew?
Or it could be 6 months after.
Yeah, but I said we weren't going to talk about that. So, 30,000 basis compared with what?
Selling price?
The sales price, which was, Jeff?
25.
28.5 from 30,000 is gain or loss? Lost how much?
1,500.
What kind of loss is this $1,500 loss? Logan,
It's not a loss.
it is not a loss?
I don't think, well, maybe I'm thinking of gift. I don't know, I like the plan where you said that.
Well, I don't like the way you said that either.
I don't know, it seems like, isn't that no man's land? Where you
Toby,
short-term capital loss.
short term, from when to when?
From the date she received the gift until the day that she sells it.
It's not a gift.
Inheritance.
the date of death to the time that she disposed of it. He died in February. She disposed of it in June. That's not more than a year. Toby says it's short term. Matthew,
I say it's long term
why?
because all dispositions yield long-term results.
Who said?
The worksheet.
The worksheet, the chart, and the worksheet. We got two different names for this. Get yours out. I need one to hold up. The chart. What's the name of this thing, Dwayne?
The name of the chart?
I guess he answered it.
It's not a chart.
Oh,
It's not a worksheet.
decision tree. It's a tree.
What is the name of this?
No, you
This
work.
is a decision tree.
You work the sheet to
This
figure
is,
out the
it's
answer.
not a worksheet. It's a decision tree.
The handout.
And Matthew, what does it say on the decision tree?
That
Help me get there. Did we acquire this property by purchase?
no,
No.
Did we acquire it by gift?
no,
Did we inherit it?
yes,
Matters not whether we elected the alternate valuation date. We're not going to talk about this. We get fair market value on the date of the death, and
long term.
all dispositions of inherited property yield long-term gains.
What is a disposition?
Or losses.
True. Or long-term. Toby,
Yes.
how you doing?
Good. I learned something new.
I thought it was like
Are y'all with me right this minute? Yes or no?
Oh yeah, that.
That's why we did
I
this.
don't know.
It's long-term. The third bullet. On July 30th, she sells land for $25,000 that was received as a gift from her brother April 8th this year when the land's fair market value was $30,000. What's her deal on getting property and selling it for losses?
I mean, it's a gain for her.
She's an artist. What do you expect?
Her brother purchased the land for $43,000 in 2003. No gift tax was paid. Her basis is 3 out of 4 times we step into the shoes of the donor. If you receive a gift of inherited property, that's all there is, of appreciated property, that's all there is to it. You step into the shoes of the donor, there's no choice. If you receive a gift of depreciated property, you have 2 potential bases. Which one do you use?
30,000.
What determines which one you use
The selling price.
is correct. You want to talk me through this? She sold this property for,
25,000.
therefore her basis will be,
30,000.
which is,
Lower than 43,000.
he paid 43 for it. We're not going to step into his shoes.
Yeah.
We're going to limit the loss to the loss that occurred in her hands. It was worth 30 when he gave it to her. She sold it for 25. Maybe it was a good thing if it's dropping like a rock. Right, Toby?
That's true.
Cut your losses. So this loss, 5,000, is what kind of loss? Help me classify it.
Short term.
Because
You gotta match the date and the dollar basis.
we learned that in another problem today. Thank you very much. Here it is. So when we chose his dollar basis, we had to match it with his date basis, Matthew's description, and a good one. That's a short-term loss. The questions are, A, what is her net short-term capital gain or loss? And the answer is this 5,000 we just talked about. B, what is her net long-term capital gain or loss?
1,500.
The 1,500 loss. C, what is the effect of capital gains and losses on our AGI? Well, I've got a short-term loss and a long-term loss. What do I do with them? Net them?
No.
How much total is deductible?
3,000.
3,000 is deductible. Where'd you get the 3,000?
From the short term.
From the short term. D, what is her capital loss carry forward to next year?
2,000 short term and 1,500 long term.
Ooh, I nearly tricked you right there. Passed up a good chance. I'm pushing that button again. Did you see this? She had a $5,000 short-term loss. She can deduct it off, yes or no?
No.
No. Just 3 of it. So her effect on AGI, okay, here we go for the carryover. Now, somebody was talking to me. Was it you, Shane?
It was.
How much?
I don't remember now.
Short term of,
2
good.
and long term of 1,500.
Short term, 5 total. We'll use 3. We're carrying over 2. And long term was 1,500. We used none of it. We're carrying over that one. And if you're with Shane and me, say yes.
Yes.
Okay. We start here next time. Please, you bring this handout with you to class. And the topic is finishing it off. It's about tax rates and a little bit more of this netting and a little bit more carryover.